Welcome to the Daily Update Podcast, where I'll go over the action in the market for Monday, May 19th, and we'll see how things look for Tuesday, May 20th. Summarizing what happened in Monday's session, the S&P demonstrated resilience, closing slightly positive with a gain of 0.09% despite trading on below average volume. The day began with a lower open, triggered by Moody's downgrade of U.S. debt, citing concerns over elevated debt levels. Prices ended up gapping lower, briefly dipping below the 5,900 level, which marked the intraday low. However, buyers stepped in, pushing the S&P above the S1 support level at 5,924 and testing resistance at the daily pivot at 5,941. Late-day buying secured a modest gain, keeping the market in positive territory. The broader trend remains firmly bullish. Both short-term and intermediate-term ADX indicators have crossed back above 20, confirming the uptrend. Prices are comfortably above the 20, 50, and 200-day moving averages, signaling strength across all timeframes. However, caution is warranted as the market appears overextended. Technical indicators such as the StochRSI, Williams %R, and CCI indicators, as well as the Stochastics, are showing extreme positive readings, showing good momentum, but possibly overextended to the upside. And the S&P is trading far above its 20 and 50 period moving averages, indicating overbought conditions. On the economic front, the leading economic index declined 1%, worse than the expected decline of 0.7%, marking 5 consecutive months of declines. If the 6-month growth rate weakens further, recession concerns may intensify. Meanwhile, the 10-year Treasury yield briefly crossed above 4.5%, but settled at 4.47%. Market sentiment, while still elevated at 70, dipped slightly from 71, remaining below the cautionary 75 threshold. Sector performance showed a defensive tilt, with healthcare, utilities, and staples outperforming, while tech and discretionary lagged. The Dow gained 0.33%, and Canada's market hit a new all-time high, but small and mid-caps struggled. Large-cap tech names such as Apple and Tesla showed mixed results, with no clear leadership emerging. Other asset classes saw the U.S. dollar weaken slightly before recovering, while oil prices held steady in the low 60s. Inflation, as measured by Truflation, is approaching 2%, and both bonds and commodities remain in short-term negative trends. Market dynamics continue to be driven by optimism and the fear of missing out, with the buy-the-dip behavior shrugging off the Moody's downgrade. A potential congressional reconciliation bill added a dose of positivity, but our technical indicators are flashing warning signs. The MACD, PMO, TTM squeeze are at extreme positive levels, with early signs of rolling over in the slope oscillator and TTM squeeze. Negative divergences in the McClellan oscillators for the S&P and NYSE and the advanced decline oscillator negative divergence further suggests a potential slowdown. Looking ahead to Tuesday, May 20th, the economic calendar is light with no major reports scheduled. Investors will likely focus on geopolitical developments, trade war rhetoric, and tariff-related news. The key economic event this week will be Thursday's initial jobless claims report, which could set the tone for labor market expectations. Seasonality offers mixed signals. Historical data indicates that May 20th tends to be quite negative, but post-election years often exhibit positive seasonality. Additionally, the week following options expiration has been positive 2/3 of the time, going back to 1980. From a technical perspective, the market remains bullish across all timeframes, but is increasingly overbought. Emerging negative divergences and high valuations, particularly in the NASDAQ 100, call for caution. Growth to value and discretionary to staples ratios are in downtrends, but showing signs of improvement and remain above their moving averages. Key pivot levels for Tuesday have been updated on the YouTube community tab. In conclusion, the market remains in a strong uptrend, but is showing signs of being overbought, and has been overbought for quite some time. Negative divergences, elevated valuations, and defensive sector leadership suggest a potential slowdown may be on the horizon. Investors should keep a close eye on volume trends, interest rate movements, and tariff developments, as these could influence the market's next move. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.